Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm John Darsie, Editor-in-Chief, and together we bring you the Morning Call. So Scott, yesterday the market continued to grind higher. We saw the Dow climb above 14,000, a big psychological level. Is this business as usual for this market?
I think they've been trying to get that elusive 14,000 for the newspapers. You know, a little quinky dink that we had Dow 14,000 right into the State of the Union, but you know, I'm not a conspiracy theorist. But you know, it's good. It brings attention to the market. It shows people that aren't involved, you know, hey, look, you can make money here if you learn how to educate yourself. You know, hey, look, you know, if you didn't manage your positions the right way during the course of the last decade or the last few years, we're at Dow 14,000. There's opportunities. Equities aren't dead, and we talk about that all the time. It's just your approach.
Yeah, so Dow 14,000, is this a time to pile into longs? You know, is Main Street going to start jumping into the equity markets now, or is this a time to be a little bit more cautious?
You know, at different stages of the market, you want to do different things. And I know for me, you know, we had that reversal, just say November, and then we had that igniting rally to start the year. So if we just actually real quickly go to the spiders, you will see, you know, here is the reversal on November 16th, and then your gap up that started this big trend. Then right around here is when you had the gap up to start the year. Went sideways. This was your time to put on core trades. This was your time to see the relative strength. Even when we broke above 1474, I believe on this breakout day, I might have had something like 13 to 15 longs. You know, then as we've been trending, you know, to the highs where we're at right now, I think I'm down to, you know, 5 longs and 1 short, and the trade changes. It goes from having core positions to trim and trail and use, you know, tack-on type strategies to create cash flow like we've been seeing in different sectors as the money's been rotating.
Is the lack of volume a concern to you at all? Something that people have been talking about a fair amount is that yesterday we got the lowest volume for a full session, one of the lowest volume sessions in the last couple of years. Is that a big red flag to you, or is that just something we've been seeing?
I think I've been asked that question for the past 2 years. And now, like you said, Dow 14,000. You know, you want volume to confirm moves, and it's a lot better when you have volume on a breakout because that shows you big money's confirming it, or volume on a bottom, or volume on a gap up after earnings. But when we're just trending along, volume's not a necessity, because if you're short and it goes up on low volume, it still hurts. You know, and if you're long and your stock goes up on low volume, you could still ring the register and make some money. So at this point, everyone's looking for a reason not to be involved in the rally, or looking for a reason, you know, to be potentially short. Right now, the market hasn't given you that many reasons to do so like that.
All right, well, we'll jump into sector spotlight with the banks. The banks continue to lead this market higher. You know, a lot of people think that maybe the banks have run out of steam and that tech might pick up some slack, but it continues to be the banks that drag this market up. JP Morgan and Goldman Sachs have been the two strongest in the sector after earnings. But I know, Scott, you've been talking about Bank of America and Citigroup in the last few days as stocks that are starting to perk back up in the sector after some rest. What do you see with those stocks?
Well, first I want to just show the XLF, which is the ETF for the banks, and the reason why, you know, it's having such a big move, and show you different relative strength type of strategies we use. If you look at the chart here of the XLF real quickly, look, this was the gap up that started the new year. And what did we gap up above? We gapped up above the September highs. That's why this was a great group to provide alpha that was showing leadership. Because if you go back to the spiders, you know, where was the gap up in the spiders? The spiders was right here, and look where September highs were. So we actually were lower than that September highs for almost a good 2 weeks. So the XLF actually was a place to be to create alpha for yourself to outperform. And then, John, within the XLF, you have different stocks, different leaders, and different setups.
Yeah, Citigroup yesterday in particular. I know you have been long Bank of America for a while, but Citigroup set up a nice ascending triangle pattern. And a couple days ago, you added to that position, or added that onto your long positions.
Well, Citigroup, you know, we spoke, I think I was on Bloomberg when they announced the layoffs, and for some reason, every time they announce layoffs, the banks go up. You know, people scratch their head, but that's just a function of the stock market. But yes, I've been holding Bank of America, which I'll get into, but it shows you how you could see a setup in a particular stock for cash flow. So if you look at Citigroup, you know, look, this is what I was watching. This is when, you know, you had a bit more of a core trade when it broke above 38 and took out last year's highs. Then you had a gap up. Look at this gap up in Citigroup. Led to some follow through, but overall we've had a nice upper level base. So this is something I haven't been holding on to, but 2 days ago I put Citigroup on, guys on the virtual trade floor saw it go green First time in a while there because I was playing for a nice add-on trade for a breakout. Then yesterday, tweeted early in the morning saying, watch the key level in Citigroup, and pow. You could have added a lot of intraday buying power to Citigroup around 43.50, and then it went as high as 44.30, up 1% or so. So, this, if you were in a swing trade, just letting it base, here's when you add a tier for cash flow. Then if you wanted to take it off from the close and just go back to what you had in the base, that's how you use a tier system in a stock even like Citigroup.
Yeah, and let's take a look at Bank of America. It also ignited yesterday and finished up around 4%. The stock has been a big winner. It might not be the highest quality bank out there, but it's coming from a lot lower levels and continues to outperform.
Well, it shows you different banks, hurt investors throughout the cycle the past 3-4 years. So if you didn't time Bank of America and stop yourself out at the right times when it was really weak, you're probably just making money back. But if you timed Bank of America, you could have made a bigger percentage, or you could have created alpha for yourself. And we've been talking about Bank of America since the summer, ever since the call spread on Bloomberg, their lunch money, and that was back at $8. You look at the chart though, like you could see different patterns evolve. That was right around here, and it broke above 8, gave you a quick move. Then what did it do? It based. This was a really nice base. It took 3-4 months. Right around here, it was getting really juicy. I think we were talking about it almost every other day. And then pow, here was another core trade above 995, right? Went up to the 10 and change. You could have sold some. Here was a nice bull flag. PS, it topped out right around here. So if you did exit this, you had to be careful and get back, because you might have felt good when you exited at 1180, but if you didn't rebuy it back when it bottomed, near the 50-day, you missed out. So anyway, here it based once again. This is when it started getting juicy, holding higher. And yesterday, you could have added at 1195, and today I think it's printing 1235. So you could have made yourself extra cash flow and stuck around for a really nice ride. And I think a lot of guys in our community have been holding this thing since the $9 area and trading around it, creating cash flow. And that's what you could do as an educated market participant.
And Wells Fargo, a lot of traders are watching, is the next one that could potentially ignite. It's a more risk-averse financial institution, more like a traditional bank, and the stock behaves in that way. It doesn't have the big swings like some of the other banks do, but it does have a nice setup and looks like it could ignite.
Yeah, I actually tried this like a week ago, right before the dividend, and it just chopped me up because, again, it doesn't move like a trading vehicle. But investors that, don't get me wrong, that have been in Wells Fargo, they didn't have to take the pain or as much pain as a decline that you saw in some of the other banks. So they're, kind of have a smoother slope, so to speak. But then in that smoother slope, there are areas. And if you look here at Wells Fargo, you will see, stock really hasn't done much, since last March, where a lot of the other banks, came well off the lows. But also, it didn't pull in as much. But right here, you have a nice base. It's starting to clear it. Almost it did the last few days. So I do think as a trade, some fast money got back involved the last few days. And now at some particular point, I do think it takes out the highs of last summer, but it's doing it at a very slow, methodical pace. And if you take a closer look here, you will see, trading above and holding above this 35.50 was a decent area. And I do think, methodically, it's going to come back and test that high there. It's just not showing leadership right now. And
then you have the case of JP Morgan and Goldman Sachs. Those are two stocks that, pre-financial crisis, those were considered the most prestigious and the best banks, and they definitely went through a tough stretch. JP Morgan with the London whale situation. Goldman Sachs has been dragged through the mud, but it seems like after earnings, quality is starting to shine through with these, and they're leading the sector and leading the market.
Yeah, and every time I look at Goldman and I see making new highs, I look at some of the other banks and they wind up following along. The price or the price pattern, so to speak, for Goldman was when we spoke about it at 121. If you look back here, this was a really nice trade. I think we had it in off the charts right around there. Gave you a nice trade, consolidated, and then if you weren't involved, here was your gap up. Okay, the gap up to start the year. We love in our swing trading course talking about gap up, gap ups that ignite a move because you could trade versus it, and from there it's been just riding the 8-day moving average, never even testing the 21 or the 50. Keeping it hard to initiate. But if you've been sitting in this and saying, you know what, I'm not selling my Goldman Sachs until it breaks and closes below the 8-day with authority, you just rode a really nice trend, and I wish you congratulations. And
what about JP Morgan? It's a similar type of situation?
JP Morgan, for some reason, you don't have to be in every bank, and it's working out pretty well. We talked about it, when they finally came out with their actual, loss from the whale. That's when it reversed. And I know we were talking about it, right around here, if you guys remember, because, you had Bank of America and Citigroup leading at that point, and this was lagging a little bit. And this was the 41.70 entry we talked about. And then there was another one once it cleared the prior high. So this one has just been the same thing, trending and holding the 8-day, and so at this point I didn't have this in my virtual trade floor. But again, you can't have all your money in just all the banks. So if you chose one or two of them and you learn how it moves and you hold it for a trend and then you trade around it with key positions and key chart patterns, you're going to be in the game no matter what. So if you chose JP Morgan or you chose Citi or you chose Goldman, as a group it's been a really nice performer, and I wish you congratulations if you profited from it.
All right, and with that we'll go to a quick commercial break and we'll come back with In the Trenches with some mortgage servicing stocks that we talked about last week.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet, at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Welcome back to the morning call. We'll jump right in the trenches with the mortgage servicing stocks, which is something that for the first time we talked about on the morning call last week. As these stocks have had a big run, they've taken over a lot of the mortgage servicing business from the big banks, which is what's driving these huge rallies, and the quality of the mortgages they're servicing is improving. That's the basic fundamental story, and the technical story has been strong as well, Scott.
Yeah, well, these things have also been, doing stair-step approaches or different patterns where it's time to add and time to just ride. And, last week we started talking about them because they were getting tight again for a tack-on type trade. So right here, if we look at one of the first ones, we'll look at OCN. As you can see here, nice little trade above this 40, but you do have somewhat of a flag type pattern right around here. So if you're looking for cash flow, if it trades above 4150 with some type of authority and volume, we talked about volume, you can get a cash flow type move like we saw in some of the banks yesterday. So this is just something to look at, something to do. If you've been riding this trend, congratulations. It's been going up for a while.
Yeah, OCN is the biggest name in the sector and been leading the sector, but there's some secondary names that have some compelling patterns as well. And NSM, Nationstar, which is, they took on a lot of Bank of America's mortgage servicing services, but NSM started to perk up yesterday as well.
Yeah, and again, in this stage of the market, you're looking for new tight setups in order to get an entry point to make cash flow. And if you look here, if you're not involved in it as a long, you see a nice wedge type pattern. This has had an unbelievable move since a year ago, but here you are again, consolidating that move, coming back to this area. So at this point, I think if you didn't get involved in it yesterday, a move above 39, and you also could see some type of new breakout on a base on base type of approach, and then here's the old high. So I do think this is set up and could be on the radar. So at this point, it's another type of targeted specific chart pattern just for a cash flow type move.
And then another name in the sector that we talked about last week is one that had a little bit more of a calculated consolidating setup near upper levels, is Walter Investment Corporation, that sort of had a long-term base building. Some of the other stocks in the sector looked a little bit extended, but this one looks like it has a great upper level pattern, right, Scott?
It's like sometimes you have leaders that just run away. Like again, with Goldman, it was hard to find a new entry. So you look for ones that have good entries for traders. And this one, look at yesterday, just started to come out of this wedge. Here's your wedge pattern where you have a series of high, lower, high, tight patterns. So yesterday, for guys that entered, congratulations, nice little move above this area. This was around 46.50, and here's a clean day. So let's see if it could take it to the highs. If the market stays intact, which it seems like it's doing, there's no reason why it can't get back to these old highs and maybe even take them out if this group remains hot. This is what you call an add-on base-on-base trade versus something like that. It was a core way back here in August. So do it a little less, but it gives you something to do for potential cash flow.
All right, and we'll go ahead and jump into quick hits, and we'll start with some big news last night in GE, which is a stock that I know, Scott, you've been long for a while, is that GE announced that it is selling its remaining 49% stake in NBC Universal to Comcast for just under $17 billion. And that news has ignited GE after hours. I know you were long based on some technicals that you saw, Scott. And this is just a little bit of cherry on top of that trade.
I want to talk about 3 or 4 different strategies within GE because it's good tactics. It's a lot of stuff we go in our educational courses about different approaches at different time frames in the market. Okay, so with GE, let's go a little trip down memory lane because we have a little bit of time. You go to the chart. Okay, if you guys remember this tight pattern here, it was getting very, very tight before earnings. Okay, so at this point, for me, I know I don't take a lot of size into earnings because you have earnings risk. So what I did is a call spread. I did a weekly. I think earnings were Friday, so we bought like the 2150s or something like that or the 21s for 40 cents, and earnings came out, and they were strong, and it gapped up. Remember that gap up? So what I did there, John, is I said, you know what? Now that the earnings risk is out of the way, I'm going to cash in my options. I don't know exactly what they were, but I think I bought them for 40, sold them for 80. It was a decent trade. But then I said, now that that's behind us, we can go back into the stock and use it as a swing trade as long as it holds that earnings move. And if you go back to the chart, that's when it went long on my VTF right here. And I said, let's see some consolidation and then look for an add-on trade. And that's what this was right here at 220 for a quick move. I remember adding, taking off, and then I went back to what I was comfortable just holding. Then yesterday, we talked about this wedge or pennant type pattern where it started to clear, where we saw strength in some of the other banks. So I'm like, why not GE? A little bank, a little industrial, a little bit of everything. So added to it yesterday. We tweeted about it. And now, boom, lo and behold, you get some news. And here we are, ready to take out that 23 and change. So for me, I will be selling some into the gap open, and then I'll probably hold some. But 3 different tactics within the same stock. And who would have thought with GE it would be so exciting?
I thought it was an old dinosaur that traders would never watch, GE, but turns out some of these names can perk up every once in a while and give you some tradable action. Apple will go into next. The stock has had well-publicized struggles since selling off from above 700, losing almost 40% of its value. Over the last few days, it started to perk up a little bit, traded into its earnings gap, but it got rejected at some resistance. And then yesterday morning, Tim Cook had his keynote address at the Goldman Tech Conference, and he didn't really say the words that investors wanted to hear. Or
at least fast money, and I would consider myself intermediate to fast money in Apple, which is the way you had to be because it's given you no reason to hold it for more than 1 or 2 days, where we had a rare occurrence last week. You actually could have stayed involved for 3 or 4 days. Ever since the high got put in, if you look at the chart here, back around 700, this was your last trending move that you saw in Apple, where it stayed above the 8 and 21 day. And I remember we did that thing with Kramer. I'm like, if it closes below the 21 day, it turns back into a trade versus a trending type of scenario. And I'm like, we closed below the 21 day, we could see the 50 day. Saw the 50 day, gave you a day and a half bounce or so, then broke the 50 day, and then I don't want to go through the whole thing, but then boom, look at this trend to the downside. We had that one tradable move right here, because look how stretched it was and went right to the trend line. And then since then, you tried again, then failed. Tried again, earnings failed. So then down here, it was worth a look. And if you guys remember, last week when it woke up right on this day, this was when it cleared this high here of like 455-ish. It became a swing trade for me, or it was green on my virtual trading floor. But then we said, look for cash flow above this 465.79, which was the earnings gap. So here it was, 4 days. Went right to a little bit past that 483.38, which is that pivot, from the pre-earnings. And then yesterday, wasn't sure if it could continue, wasn't sure if we'd get some fireworks, and we got nothing. Okay, when it broke 475 at I think like 10:30ish, I was like, you know what? I'm done. Let's let it sift out. He obviously, is being the Tim Cook that he's been, which hasn't been too shiny or too charismatic or too investor friendly. Maybe it's company friendly, and at some point it'll pay off. Like you would tell me a little bit about the watch and some of the news out there.
Yeah, I mean, Tim Cook's been acting with a lot of hubris lately. He's sort of shrugged off investors that are concerned about the pile of cash that Apple has. But if he's going to act in this arrogant manner, he better have something in the pipeline. And we've gotten some reports over the last few days. It could be the iWatch, which is something that could completely revolutionize the mobile game, and it's sort of bring a lot of what you have in your smartphone into your wrist, and it could become your keys and your wallet and your phone and all that. And it could be another game changer from Apple that maybe that'll stir some excitement in Apple with some of those reports we've seen the last few days.
It could start a new wave. Obviously, it's on your wrist, so it would have to be big enough that you could use it for maps. You could use it for your phone. It has to be some kind of Bluetooth where you could talk to it. Like, it could be really cool. And then it could be fashionable, and then it could be a lot of things. But right now, all it is a blog post, for us to look at. So at this point, I'll let that be in the future, and I'll let the price action, show me where to go. And if you look one more time at this chart, what we do have now is yesterday's low as a point of reference. You have 460. 467.74. And then I would think if Apple's any good, it should really not get too much below, 462 to 465, which comes right around here. The shareholder meeting, I think, is February 27th, so we have a lot of time between now and then for some rumors and some, actually can't say the word rumors, but for some news to come out on different wires and hit the media, and then the stock will go back and forth. So I'm just going to trade it until I see something a bit more clear cut.
All right, another high-profile name that's run into some struggles since its earnings report is Facebook. Stock had a big run. We listed it out of that cup and handle pattern in your 2013 predictions. It actually reached your target area very quickly, so it's time to reduce expectations a little on that trade. But it's come into some problems since earnings.
Yeah. Well, it's actually I felt like a champion, in January because I'm like we wrote it together. 32 to 34, and I sold it there. I was in my virtual trade floor. It was one of my swing trades I had it the entire time. So it was methodical and moved well. So actually, let's just look at the chart real quickly. You go to the chart, you'll see this is when it was really calculated right in here. Fill the earnings gap. So this was your trade from 24 to 27. And I do believe we wrote saying, it was like right around 26. I'm like, we could probably see 32 to 34. That was the reason. So got out of it. But then, I got a little screwed up right around here when I went back to it. On earnings day, if you remember, it actually, the expectations were high. The earnings were decent. And basically, you remember after hours, there was two trades there that got me excited. I know after hours, it was trading at 28, which is a spot I wanted to buy it. So it went from negative to positive after hours. And then the next day, it opened down $1, went from negative to positive. So I was like, you know what? I'm like, the forces of will want this higher. So I kind of, put an opinion in my head just to stick with it. And meanwhile, it showed relative weakness. And you had the Barron's article, then it showed relative weakness again. And now you go back to the chart where we're at. This was your typical, bear flag continuation. So, I've given back some money in Facebook. Let's see how it handles this prior area. Hopefully, we see some kind of bottom type candle to get back involved. And I'd still stand behind the fact that this high right here is not the high of the year. Thank goodness we have 10 months to go or so.
Yep. We'll transition into the home builders. We've talked about the financials and the home builders being two of the strongest sectors in the market over the past, year almost, really leading the market higher. And the home builders woke up again yesterday along with the financials. It's, like I said earlier in the show, it's business as usual for this market. Same leaders, techs lagging, but the market doesn't really seem to care.
And Sperling had a great call. 2 days ago, he's like, you know what, guys? If you want to be a momentum monkey, because that's what we're called sometimes, give me a banana. I'll take it anytime because, yesterday there was some nice momentum in the banks.
You get the low-hanging fruit, right?
Yes. Well, he's like, let's buy, he's like, I'm buying some of the home builders into the 21-day. And then I actually tweeted it out because he's too busy tweeting. So anyway, you look at the chart here, and you will see it was right into the 21-day. Okay, this is the first time the home builders let the 8 and 21-day catch up from when it ignited the last time in December. And then pow, yesterday went in motion, cleared to the highs, and some of the home building stocks reignited. So if you wanted to buy the dip, you could have done so, or you could have waited for it to go in motion. So overall, still trending. Again, I wouldn't say it's a core trade up here, but it's something to do.
Yeah, and we'll close out the quick hits on the show with some talk about the 3D printing stocks, which not all is rosy in this market. I mean, these stocks have had huge runs, but they're starting to show some cracks in the foundation a little bit. You had that hugely successful IPO from XONE. It was XONE is the symbol. It was priced, the range was 16 to 18. The IPO was priced at 18. The stock traded almost to 34 in the first 2 days, which seemed a little bit overdone in my opinion. I'm not as bullish on the sector as some. On Friday in the morning call, we talked about how it's some time for some caution in a stock like SSYS and Triple D. And yesterday we got a big breakdown in those two stocks.
I think Chart Girl had SSYS.
We had it on off the charts as well, out of that ascending channel
for a potential short.
Yep.
So again, a lot of different opinions too, because a lot of people on the trading floor were trying to see if it could hold up. For me, I was just avoiding it. I've been just playing extremes. But if you look at Triple D here, you will see that this was the first crack in the armor, so to speak, when you had a high-level flag that got squashed. And look at the potency of this down move. Then from here, it became a decent trader. Look, it touched a 50-day. This is, I think I played it just for a quick move here, held higher, it ignited right back up to below the prior high. Then it got a little faulty here, so it was questionable. I think this one acted better than SSYS because A, it's a bit more quality, and B, they announced a 3-for-2 stock split. But anyway, you did have a wide range bar to the downside. I would say it's not game over here. What I would do is I would draw a really big wedge. Okay, because obviously the market's trying to figure out if this move from the past 2 years or even further is getting a little bit too overextended. So at this point, just be a bit careful. I would micro trade it. You know, you had a good short here, then a decent long here. Some guys made money short there, and then we'll see how it handles today's low, you know, 62.26. Maybe it does some kind of bar like this. And the same way you go SSYS, which was a bit weaker. Now this one looks a lot different. This one looks like it's, you know, breaking. Here is your gap up where it gapped up, closing the lows. That's always a little bit of a sell signal right there to just take something off the table. Then you had immediate follow through to the downside. Then it never took back really 50% of that bar and broke this little uptrend. Boom. Then what happened here, you had a tradable red dog reversal that wound up getting stuck halfway into this potent bar. And then yesterday, pow, broke this little ascending channel, closing the lows. So this one, you know, could be in a little bit more trouble than the other, but see, if it continues, you know, I wouldn't just close your eyes and say I could buy this one again the way it's been for the past few years.
Yeah, and these 3D printing stocks, as a quick note, have been great trading vehicles. And there's something that every day in the Momentum chat room, Mike Lee and Steve LeVay focus on these very heavily. They give you really fast moves, and they're very conducive to the style of trading that you see. You know, if that's the style that you are attracted to, I would take a free trial of their room and get a little feel for that. That'll do it for today's show. We'll see you out on the virtual trading floor. Thanks for joining us. Have a good day.
Most people say you can't time the market. I say you have to. I'm Scott Redler, Chief Strategic Officer for T3 Live. I would like to invite you to an exclusive swing trading event in Newport Beach, California on Saturday, February 23rd. Students will learn the 5 keys to becoming a successful swing trader and how to navigate the market using what I call a portfolio approach when it's conducive in the market. Reserve your seat at t3live.com or call our toll-free number 1-888-99-T3 Live.